In this video, I'm going to break down buying term and investing the difference, one of the most effective structures we use to help our clients to optimize their life insurance purchase. Life insurance policy shopping can be a very confusing, overwhelming experience. Do a quick Google search, and every blog and video that you will land on will likely end up answering your question, but leave you with two new questions that you hadn't even thought of before. One particularly common question that you have either asked yourself or come across when you're looking for the right life insurance policy: what kind of policy is right for me? Term life cover or whole life cover? And if you have this question, you are likely to run into the buy term and invest the difference argument. Over the next few minutes, I'm going to give you an essentials only overview of buying term and investing the difference, along with the most important considerations for you to keep in mind when opting for this structure. One is term insurance. With the term insurance policy, you pay a fixed premium for a fixed period of time. And during this term, your beneficiaries are eligible to receive the stipulated death benefit. Terms can be anywhere between 5 years and 35 years, with some companies even offering cover till the age of 100, after which point you may be allowed to renew the policy on an annual basis at fixed or increased premiums. If you choose not to renew, much like a car insurance policy, you are no longer insured at the end of the term. The other type of policy that you can purchase is a whole life or a universal life insurance policy. As the name suggests, the whole life policies provide cover for your whole life. These policies have significantly higher premiums than term insurance. Term life insurance premiums can be as low as a third of the premiums you would pay for a whole life policy with the same amount of cover. For some people, the difference in pricing makes term life the attractive proposition. But we're going to put that difference to a different use by taking it one step further. That's where buying term and investing the difference comes in. Buy term and invest the difference is a method where you buy the cheaper term insurance policy and in turn invest the difference that you save. The idea behind this is that investing the difference independent of the life insurance policy would generate significant returns that would continue to grow in your savings plan even after the term insurance expires. These are, however, some key considerations to bear in mind. Number one, the forced savings aspect is important. One of the most common mistakes made is buying term insurance and spending the difference instead of investing it. That leaves the insured and their family with no death benefit at the end of their term and no savings to fall back onto either. Number two, another consideration is whether the insured requires the insurance cover beyond the age of gathering wealth. If you have essentially retired and your family or you and your partner are either living off the wealth you have accumulated or off the returns from it, then having cover beyond that retirement age essentially relates to wealth creation and not wealth preservation. This is more of a luxury than an absolute necessity. Number three, this structure can get complex and fall apart if you get the details wrong. You might need the advice and support of a financial advisor to make lucrative investments with the difference saved. With little or no experience in investments, or with the wrong life insurance policy in place, you might end up insufficiently covered. A stable investment return, however, can put you miles ahead of where you would be with a conventional whole life insurance policy. Number four, you might have different reasons for buying a life insurance policy, and the death benefit might not be your focus. I work with several high net worth individuals who utilize life insurance in many different ways, including charitable giving, diversifying investments, offsetting tax liabilities, estate equalization, wealth preservation, wealth transference, business planning, risk management, and more. All in all, it might be worth considering that your financial goals largely determine what type of policy is best for you. The market today is full of bespoke solutions to address a variety of needs. Each product and solution comes with its sets of pros and cons. The key lies in trying those pros and cons to your short and long-term financial goals and picking the policy that best accommodates those goals. Being spoiled for choice can work entirely to your advantage if you know how to maneuver through your options. If you don't, speak to someone that does.